So I want you to try and picture the financial landscape back in 2009.
Oh, wow. Yeah, that is a grim place to start.
Right. Try to put yourself back in that specific, like, post-financial crisis mindset. I mean, the banking system had basically just collapsed.
Totally. Trust in traditional finance was just at absolute zero.
Exactly. Zero. And out of that chaos, you have this brand new, almost, I don't know, almost mystical digital asset just floating around the obscure corners of the internet.
You're talking about Bitcoin.
I am. We're talking about Bitcoin. And back then, I mean, it was worth less than a single US dollar.
It was literally just an experiment for cryptographers.
Yeah, but then fast forward a bit and we all watch what happened next,
Right, the explosive headlines.
The headlines, the overnight billionaires. You start seeing the birth of entirely new hedge funds and 20-somethings just buying fleets of Lamborghinis.
It was the creation of an asset class that essentially defied financial gravity.
It really did. We witnessed what is arguably the fastest, most explosive wealth creation event in the history of capital markets.
Without a doubt.
But here's the premise we're unpacking today in this deep dive. And I'm going to be honest with you. When I first read the research for this, it sounded entirely made up.
I had the exact same reaction.
Because despite the spectacular, jaw-dropping 1,000,000% returns of cryptocurrency, Bitcoin has not created anywhere near as many millionaires as the most boring, bureaucratic, just mind-numbing piece of paperwork hidden inside your standard corporate HR packet.
It's true. The 401k.
American 401k.
I mean, it sounds completely absurd when you put those two things side by side.
It really does. The contrast is almost comical.
Right, because you have this hyper-volatile, futuristic money on one hand, and on the other you have this mundane retirement account that, most people set up in 10 minutes while they're trying to figure out where the office printer is.
Exactly. And then they completely forget about it for 3 decades.
But the data does not lie. I mean, the numbers overwhelmingly favor the paperwork.
See, I'm going to need you to walk me through the logic here. Because my immediate reaction is just pure skepticism.
Which is fair.
Like, how does that even work mathematically? We are talking about Bitcoin going from pennies to tens of thousands of dollars.
Right.
How can a retirement account, something you fill out in a sterile office while sipping lukewarm break room coffee, possibly outpace the fastest wealth creation engine we have ever seen? The math just doesn't seem to add up.
Well, to make sense of that, we really have to untangle a massive misconception in how people view finance.
Okay, what's the misconception?
We have to separate the concept of high asset returns from actual realized wealth creation, because those are two completely different things.
Okay.
The 401k was never built to make you rich overnight. It doesn't have the capacity for explosive lottery ticket returns.
Right. It's not crypto.
Exactly. It was engineered to make ordinary workers wealthy so slowly and so quietly that they barely even notice it happening. It's just a completely different mechanical engine.
So Bitcoin is an asset, but the 401k is...
The 401k is a behavioral system.
Okay, I'm tracking with the difference between an asset and a system. So if we're going to understand how the slow-motion wealth machine actually operates, the sources point out that we have to look backward first.
Right, to the origin.
Yeah, we need to look at the specific economic crisis that accidentally birthed it. So let's rewind to the late 1970s.
Specifically around 1978.
Yeah, 1978. Paint a picture of what is happening in the American economy at that moment, because from the research, it is looking incredibly grim.
Oh, it's a phenomenal period of economic stress.
Yeah.
You've got rampant inflation just eating away the purchasing power of the middle class.
We're talking double-digit inflation. Really.
Double-digit, yeah.
Yeah.
Plus, shifting labor markets, oil crises, and this immense growing pressure on the traditional mechanism that dictated how people stopped working.
Okay, let's define that mechanism. Before the 401k existed, what did the finish line actually look like for the average American worker?
Well,
because my grandfather had a pension, and from my memory as a kid, it seemed like a pretty ironclad, stress-free deal.
and it was. It was a fantastic deal for the worker. It was called a defined benefit pension.
Defined benefit.
Right. And for decades, that was the absolute gold standard of American labor. The agreement between a corporation and a worker was incredibly straightforward.
How so?
The employer essentially promised you a guaranteed, steady income for the rest of your life once you reached retirement age. They defined the benefit you would receive.
And the critical dynamic there is the allocation of risk, right?
Precisely. Under the defined benefit model, the corporation carried 100% of the investment risk.
Wow, 100%.
Yeah. They had to take a portion of their profits, put it into a massive pension fund, hire managers to invest it, and figure out how to mathematically guarantee that promise decades into the future.
So as an employee, what did you have to do?
Your only real obligation was loyalty. You put in your 20 or 30 years on the assembly line or at the desk, and the company took care of everything else.
That sounds amazing, honestly.
It was. You didn't have to know what a mutual fund was. You didn't have to follow the stock market. You just had to do your job and clock out.
But that straightforward agreement fractured. And based on the research, it wasn't because companies suddenly decided to just, be greedy.
No, not at all.
The actual mathematics underpinning those corporate promises just completely broke down. So why did the math stop working?
It broke down due to an unavoidable collision of demographics and economics. The actuarial tables essentially flipped.
Meaning what, exactly?
Well, when pensions became widely popular in the early and mid-20th century, life expectancy after retirement was relatively short. Let's say a worker retired at 65. The statistical probability was that they might live to 68 or 70.
Oh, wow. So the company is only on the hook for, 3 to 5 years of payouts?
Exactly. 3 to 5 years is a highly manageable liability for a large corporation. But as we move into the 1970s and 1980s, medical care improves drastically.
Right. People start living longer.
Life expectancies stretch. Suddenly, that worker retiring at 65 isn't dying at 70. They're living to 82, 85, sometimes 90.
Oh, man. So now, instead of funding 5 years of retirement, the corporation has to pay that retiree for 20 or 25 years.
Exactly. Now multiply that by tens of thousands of workers.
The liabilities just go vertical.
They became crushing weights on corporate balance sheets. General Motors, for example, they famously became known as a giant pension fund that occasionally manufactured cars to fund its liabilities.
That is insane.
The math simply became unsustainably expensive. Corporations realized they were going to go bankrupt if they continued guaranteeing lifetime income to a workforce that was living decades longer than originally projected.
Right, so when the math stops working for the corporations, the rules inevitably change for the workers. They have to.
They do.
But what is truly wild about this historical transition, and this blew my mind when going through the sources, is that the solution to this massive systemic pension crisis was not some grand master plan.
Not at all.
There was no room of brilliant financial architects sketching out the future of American retirement. It was just a clerical accident, a loophole.
A completely unintended loophole buried in a piece of tax legislation.
So how did it happen?
Well, we're looking at November 6, 1978. Congress passes the Revenue Act of 1978. And hidden deep inside that legislation was the creation of Section 401k of the Internal Revenue Code.
Just a random line item.
Basically, yeah. It is vital to understand the historical context here because Congress did not pass this, intending to revolutionize the American retirement system.
Nobody on Capitol Hill thought they were replacing pensions.
Nobody.
So what was the actual point of it?
It was viewed as a minor, almost insignificant provision. It was just a little tweak allowing employees to defer a portion of their salary into a tax-advantaged savings plan.
Like a niche thing.
Exactly. In reality, it was largely drafted for highly compensated executives who were trying to defer taxes on their end-of-year cash bonuses. It was just a tax shelter.
Enter a guy named Ted Benna in 1980.
Right, Ted Benna.
He's a benefits consultant, and he's digging through this obscure, boring section of the tax code. He looks at Section 401k, and he realizes its true potential, right?
Yeah, he essentially hacks the tax code to implement the first practical 401k plan for a client.
But this wasn't just a new type of bank account, was it? The sources suggest this represented a fundamental seismic shift in the relationship between labor and capital in the United States.
Oh, absolutely.
Break that down for me.
It changed the entire economic philosophy of what it means to be a worker. In a single pivot, the responsibility, the risk, and the ownership shifted completely from the employer to the employee.
So it's all on us now.
Right. Instead of waiting on a paternalistic corporate promise, a promise that might evaporate if the company went bankrupt, workers were now automatically purchasing stocks and bonds before taxes were even deducted from their paychecks.
The psychological shift there is massive.
It is. You didn't retire because a company paid you an allowance. You retired because you, personally, owned a diversified portfolio of assets.
You transitioned from being strictly a wage earner to becoming an owner of capital.
Exactly. You own tiny slices of the global economy.
And looking at the data today, the scale of what this accidental loophole became is staggering.
It really is.
Just taking Fidelity as one single example from the research, they alone administer 25.6 million 401k accounts across 26,800 different employer plans.
That's just one company.
One company. We are talking about trillions and trillions of dollars collectively held in these accounts across the country. It is a phenomenal aggregation of wealth.
It is, but we have to be careful not to confuse the macro statistics with the micro reality.
Yeah, okay, what do you mean?
Because simply throwing trillions of dollars into a massive aggregate system does not automatically translate to individual workers becoming wealthy. Having access to a financial system and successfully navigating it to the point of becoming a millionaire are two very different things.
Okay, that is the perfect pivot. To really understand the millionaire-making power of the 401k, we have to tear the engine apart and look at the actual mechanics.
Let's do it.
Because the sources lay out 5 specific interacting mechanisms that drive this wealth creation. And I want to spend real time on each of these because this is where the theory turns into actual dollars.
All right.
Let's start with mechanism number 1, which is entirely behavioral. I want to set up a scenario from the research.
Okay, go ahead.
You have 2 employees sitting in adjacent cubicles, both earning $80,000 a year. Employee A decides to manually invest 10% of their income every single month. On the 15th of the month, they log into their brokerage account, they transfer the funds from checking, and they buy an index fund.
Okay, standard manual investing.
Right. Then employee B uses a 401k to automatically deduct that exact same 10% from their paycheck before they ever see it. On a spreadsheet, the math is identical.
Yep, the math is the same.
But in reality, the data shows the manual investor almost always loses. Why is employee A doomed?
Because the manual investor is relying on human willpower. And when it comes to money, human willpower is incredibly fragile.
It really is.
It's susceptible to every emotional whim, every news headline, and every short-term desire. The behavioral economics principle at play here is called pay yourself first. But the actual mechanism is cognitive load.
Explain the cognitive load part.
If you have to manually transfer that money every single month, human nature guarantees you will eventually stumble. You're forcing yourself to feel the pain of parting with your cash 12 times a year.
You're introducing a decision point every 30 days, and every decision point is an opportunity to fail.
Precisely. You will inevitably have a month where, the car breaks down, or your kid needs braces, or you just really want to go on vacation, and you rationalize it.
Oh, I've done that. I'll skip it this month.
Right. You say, I'll skip the investment just this once, and I'll double up next month. But you never double up.
Never.
Or even more commonly, you turn on the financial news, the stock market is crashing, the pundits are screaming about a recession, and you hesitate. You hold the money in your checking account, waiting for things to calm down.
Which usually means missing the recovery entirely.
Exactly. The 401k works because it completely removes human behavior from the equation.
It just happens in the background.
The money disappears before it ever hits your checking account. You never see it in your available balance. You never feel the psychological pain of losing it to savings, and you never have to actively decide to invest it.
So the real genius of the system isn't the underlying mutual funds.
No, it's the automation. It acts as a firewall against our own psychological flaws.
I buy that. Automation is a powerful defense mechanism. But let's move to the second mechanism. And this is where I need you to explain the corporate logic, because this is where the 401k completely breaks away from normal investing reality.
You're talking about the match.
I am talking about the employer match. The data shows roughly 78% of 401k plans include a match, typically between 3% and 6%, though some stretch up to 9% or 10%.
Right.
Stop right there. If a guy in an expensive suit on Wall Street tells me I'm getting a guaranteed 100% return before the market even opens, I'm checking my pockets, assuming it's a Ponzi scheme, and calling the SEC.
It does sound like a scam when you frame it that way.
What is the catch here? Why would a profit-driven corporation just give away capital like that?
Well, it looks like free money to the employee, but for the corporation, it is a highly calculated business expense. There are 2 primary drivers.
Okay, what's the first one?
First, there are significant tax incentives. Employer contributions are tax deductible for the corporation, which lowers their overall corporate tax burden.
Ah, okay. That makes sense.
Second, and more importantly, it is a crucial retention tool. The cost of recruiting, hiring, and training a new employee is vastly more expensive than offering a 5% match to keep an experienced employee happy and locked in, especially since matches often vest over several years.
So it's golden handcuffs.
It is a form of golden handcuffs, but it's one that benefits you immensely. Let's walk through the actual math of a standard 100% match on the first 5% of your salary.
Okay, let's hear the math.
Let's say you're earning that $80,000, and you decide to contribute 5%, which is $4,000 for the year. The moment that money hits the account, your company immediately deposits another $4,000 alongside it.
So before my chosen mutual funds go up or down a single fraction of a percent, I have doubled my money.
You have achieved a 100% return on your capital instantaneously.
That is wild.
If you try to find that anywhere else in finance, you can't. It doesn't exist. If you buy real estate property, the seller doesn't hand you an extra house.
Right. If you buy Bitcoin, the exchange doesn't double your coins just for participating.
Exactly. But in the 401k system, this immediate doubling of invested capital is standard operating procedure for millions of workers. It drastically accelerates the raw fuel going into the engine.
Okay, so the match gives me a 100% return on day one. That is fantastic. But an extra $4,000 or $5,000 a year still doesn't equal $2.5 million at retirement.
No, it doesn't.
There has to be another engine driving this, which brings us to mechanism number 3, the mathematics of compounding.
The big one.
This is the core of it all, but I want to get granular here because people throw the word compounding around like it's magic.
They do, and it's hard to visualize.
So the sources outline a very specific scenario. A 25-year-old worker puts $500 a month to a diversified index fund inside their 401k.
Okay.
We assume a historical 10% average annual return, and they do this religiously until they reach age 65. Over those 40 years, the total out-of-pocket contribution, the actual cash pulled from their paychecks, is $240,000.
Right.
But the final balance sitting in the account at age 65 is approximately $2.65 million.
Yep.
The most surprising statistic here is that over 90% of that final wealth was never contributed by the worker. How is the market just handing me $2.4 million?
It isn't handing it to you all at once. It's growing it through a mathematical feedback loop. Over 90% of that final number was generated by compound growth.
Returns on returns.
Exactly. The returns generated returns, and then those returns generated more returns. But we need to address the reality of living through this math, because there is a massive psychological trap buried in this 40-year timeline.
What is the trap?
It's a trap that causes millions of people to abandon the strategy entirely. The trap is how incredibly meaningless the first decade feels.
Meaningless? How so?
Think about compounding like pushing a snowball down a massive 40-year hill. At the very top, the snowball is tiny. You are pushing it, you are putting in the effort, but it doesn't seem to be gathering much snow.
Okay, I can picture that.
Let's look at the actual numbers for that $500 a month scenario. After 5 full years of discipline, 60 months of never missing a contribution, you only have about $39,000.
Ouch.
Right. And after 10 years of consistent sacrifice, a full decade of your working life, you have roughly $95,000.
I can feel the frustration just hearing those numbers. You sacrifice for 10 years, you give up vacations or a nicer car, and you haven't even cracked $100,000.
It's demoralizing.
I can completely see someone looking at that statement and thinking, this is barely moving the needle. I'm never going to be a millionaire at this rate. I should just pull the money out and start a business or buy crypto.
That is exactly what happens to the human brain, which evolved to think in linear terms, like tracking a predator running at you at a constant speed. You look at 10 years of effort yielding less than $100,000, and you extrapolate linearly.
You think, okay, 20 years will be 200K, 30 years will be 300K.
But compounding is exponential, not linear.
Right.
The human brain struggles to comprehend exponential curves. Because the growth accelerates as the balance grows, the snowball gets wider and gathers vastly more snow with every single rotation. The final 10 years of that 40-year window produce more wealth than the first 30 years combined.
Wow. The math just goes vertical.
It just goes vertical. The text brings up a perfect real-world example of this phenomenon. Warren Buffett.
Right. The fact that he accumulated the vast, overwhelming majority of his tens of billions of dollars after he turned 60 or 65.
Exactly. It wasn't because he suddenly discovered a magical new way to pick stocks in his senior years. His investment acumen was always there.
So what changed?
The reality is that the math just finally reached the vertical, explosive part of the exponential curve. Time is the dominant variable in compounding.
That makes sense.
The 401k millionaire achieves that status simply because they survive the boring, agonizing, seemingly unproductive first decade so that the math can explode in decades 3 and 4.
But surviving those decades doesn't just mean fighting boredom. It means surviving real-world market crashes.
That's the hard part.
And that leads to the fourth mechanism. A 10% average return sounds fantastic in a vacuum on a spreadsheet. But the real world involves the market violently plummeting.
It does.
It involves the dot-com bust in 2001, the Great Recession in 2008, the pandemic crash in 2020. I mean, I remember checking my accounts in 2008 and feeling physically sick.
Everyone did.
So how do these ordinary workers survive those catastrophic drops without their wealth being permanently destroyed?
They survive it through a mechanical process built into the 401k called dollar cost averaging.
Dollar cost averaging.
Right. And this is where the automation we talked about earlier becomes your greatest tactical weapon. Because the payroll deduction is completely automated, it happens every 2 weeks, regardless of what the financial news is screaming.
So you're consistently buying shares at constantly changing prices, completely blind to the headlines.
Exactly.
I'm buying blindly. Explain why that is an advantage, because normally buying blindly sounds like a terrible strategy.
Well, think about the economic reality of a market crash. Let's go back to your $500 a paycheck. When the market is booming and at an all-time high, your $500 buys a certain number of shares. Let's say shares are $100 each, so you buy 5 shares.
Okay, 5 shares.
But when the market collapses by 40%, as it did in 2008, the price of that share drops to $60. Your fixed $500 contribution doesn't stop. It automatically deploys, but suddenly it is buying more than 8 shares of those exact same companies.
Wait, so the crash is actually accelerating my accumulation of assets.
Precisely. You are acquiring assets at historically discounted valuations without having to actively make a scary decision to buy the dip.
Wow, I never thought of it like that.
Think about how hard it is to manually log into an account and buy stocks. When every news channel is saying the banking system is collapsing, it requires immense emotional fortitude.
Oh, it's impossible. I'd be hoarding cash.
But the 401k does it for you. Those shares accumulated during the panic of 2008, when most manual investors were fleeing to cash and locking in their losses, became the absolute most profitable purchases of these workers' entire lifetimes when the market eventually recovered.
So the system basically automates courage.
Automates courage. I really like that framing. Yeah.
It forces you to buy low, which is
Right.
the golden rule of investing that human emotion usually prevents us from doing.
Exactly.
Let's look at the fifth and final mechanism, the tax engine. We always hear that taxes are the hidden enemy of investing. It's the silent leak in the boat.
It really is.
How does the 401k structure actually shield this compounding wealth over 40 years?
It essentially operates 2 different tax engines, depending on what the employee chooses. The traditional route and the Roth route. And they tackle the tax problem from opposite ends.
Okay, let's start with traditional.
The traditional 401k shields you on the front end. It uses pre-tax dollars. So if you make $100,000 and you contribute $15,000 to a traditional 401k, the IRS only sees your income as $85,000 for that year.
Okay, so you get immediate, substantial tax savings on your current income.
Right. And then that money grows without being taxed year after year. You only pay taxes decades later when you pull the money out in retirement, ideally when you're in a lower tax bracket.
And the Roth option flips that entirely, right?
The Roth is post-tax. You pay the taxes up front on your income just like you normally would. You get no tax break today.
So what's the benefit?
The incredible, almost unfair power of the Roth is on the back end. Decades of compound growth. All those returns, compounding upon returns, can be withdrawn in retirement completely tax-free.
Wow.
You never pay a single cent of capital gains taxes on the millions of dollars of growth.
To put that into perspective, the text applies that famous Albert Einstein quote. Whether he actually said it or not, the math holds up about compound interest being the 8th wonder of the world.
Right, it's a great quote.
Let's expand on that leaky boat metaphor. If you're investing in a normal taxable brokerage account, you have a bucket catching rain. But there are holes in the bottom.
Lots of holes.
Every time a dividend is paid, you owe taxes. Every time you sell a fund to rebalance your portfolio, you owe capital gains taxes. Your account is constantly leaking capital to the IRS every single year.
And in finance, friction is the absolute enemy of velocity.
Oh, that's a good way to put it.
By removing that annual tax drag, by plugging those holes in the bucket, the 401k allows the exponential math to operate in a completely unhindered, sterilized environment.
So the returns compound on the principal.
Yep, the returns compound on the previous returns, and crucially, the returns compound on the money you would have otherwise handed over to the government in taxes.
That uninterrupted frictionlessness is what makes the math explode in the final decades.
It's beautiful math.
Okay, let's stop the celebration for a second.
Okay.
We've laid out this mathematically perfect, heavily incentivized, psychologically protected machine. We have free corporate money, tax shields, automated courage, and compounding math.
Right. Sounds flawless.
If the 401k is so utterly flawless, why isn't every single retiree in America a millionaire? Because we know that is absolutely not the reality out there in the real world.
You're right to pull back because the statistical reality is actually quite severe for millions of people. A machine this powerful only works if you turn it on, put fuel in it, and most importantly, let it run uninterrupted.
Right. And looking at the Federal Reserve data highlighted in the sources, the numbers are sobering.
They're very tough.
38% of Generation X households have absolutely zero retirement savings. Zero. Nothing. And for those who do have savings and are approaching retirement age, the median balances are nowhere close to the industry benchmarks. Fidelity recommends having roughly 8 times your annual salary saved by the time you hit age 60. The median American is missing that mark by a mile.
Yeah, they are.
Where exactly is this flawless system breaking down?
Well, when we analyze the data, we see 4 primary failure points where the system fails the worker or the worker fails the system.
Okay, run through them.
First, access. Millions of Americans simply never had access to this machine. If you work in the gig economy, if you're an independent contractor, or if you work for certain small businesses that can't afford the administrative overhead, you might not have an employer offering a plan.
Which means you miss out on the automation and the match. You are forced to be the manual investor we talked about earlier.
Exactly. Second, people contribute too little. Many workers enroll but only put in 2% or 3%. While it is better than nothing, it simply isn't enough raw fuel to get the compounding engine generating the kind of mass required for a multi-million-dollar payout.
Okay, what's the third?
Third, they start too late. We talked about how the final 10 years are where all the magic happens. If you don't start investing until you are 45, you are entirely missing those crucial exponential growth years of decades 3 and 4.
That makes sense. But the fourth failure point is the one the sources emphasize as truly devastating. And I want to dig into this because it happens all the time. Early withdrawals, taking the money out before you retire.
Early withdrawals don't just slow the machine down, they destroy the math from the inside out.
Let's run a hypothetical based on the text. Imagine a listener out there right now. You're 30 years old, you've been responsible, and you've managed to save up $30,000 in your 401k.
Okay, nice start.
But life happens. Maybe you want to buy a house and need a down payment. Or maybe, and this is incredibly common, you are drowning in high-interest credit card debt that is keeping you awake at night.
Very common scenario.
You look at that 401k balance and think, I'll just take out that $30K now to solve my current emergency. It's my money anyway, and I have 35 years to build it back up. It's so tempting.
I can hear someone listening to this right now thinking, I need that house now. I can't wait until I'm 65 to live my life. What is the actual cost of solving today's problem with tomorrow's money?
It is the most expensive money you will ever spend in your entire life.
Okay, show me the math.
Let's go back to the snowball in the hill. When you take that $30,000 out at age 30, assuming our historical 10% long-term growth rate, it does not cost you 30 grand.
Oh, what does it cost?
You aren't just shaving a little snow off the top of the snowball. You are stopping the snowball entirely, walking halfway back up the hill and starting over.
Oh, man.
Because you are severing the exponential curve right when it is about to steepen. That single $30,000 withdrawal costs you more than $500,000 of lost retirement wealth by the time you reach age 65.
Wait. $500,000 for a $30,000 withdrawal?
Yes, $500,000.
That is sickening.
This is why financial planners try to aggressively reframe how people view these accounts. They are not savings accounts, they are not emergency funds, they are time machines. Time machines? Explain that.
The real tangible asset you are holding inside that 401k is not the cash value you see on the screen when you log in today. The actual asset is the uninterrupted decades ahead of it.
The time itself is the asset.
Exactly. Every single dollar you remove in your 30s or 40s physically burns years of future compounding. You aren't just losing the money, you are losing the hill.
You are stealing from your 65-year-old self at an astronomical interest rate to pay for a house today.
That is a brutal but perfectly accurate mathematical reality.
But, while the consequences of interrupting the math are devastating, the sources also point out that millions of Americans are actually getting this formula right.
They are.
The broader data presents a surprisingly optimistic counterargument to the constant retirement crisis narrative we see in the media.
It does. It's a tale of two realities. While the bottom quartile is struggling, those who are engaged with the system are succeeding at unprecedented rates.
What does the data say?
We are actually seeing record savings rates right now, across the board. American workers who participate in these plans are currently contributing an average of 9.6% of their salary.
Okay, almost 10%.
Right. And when you add in the employer match, which averages about 4.8%, you get a combined annual savings rate going into these accounts of 14.4%.
Which is incredibly close to that golden 15% industry recommendation that financial advisors are constantly preaching.
Exactly.
But I have to push back here on behalf of the listener. I can hear people listening to this right now screaming at their dashboard. Must be nice to save 15% of your income. I've got rent, daycare, and groceries that have doubled in price over the last 3 years.
Completely.
How does this 14.4% math actually apply to someone living paycheck to paycheck? How are average workers achieving this without starving?
That is the exact right question to ask, because willpower and budgeting alone do not explain a 14.4% savings rate in an inflationary environment.
Right, so what explains it?
A huge driver of this success goes back to the behavioral hacks we discussed earlier, specifically two mechanisms that behavioral economists championed: automatic enrollment and automatic escalation.
Right, break those down for me.
Automatic enrollment gets you in the door. Historically, you had to ask HR for the paperwork to join the 401k. Now, most large companies automatically enroll you at, say, 3% on day one.
Okay, so you're just in.
Right. If you want the money, you have to actively fill out paperwork to opt out. It flips the default.
And what about automatic escalation?
Automatic escalation is the real secret weapon that solves the "I can't afford to save 15% problem. Every year, typically tied to when annual raises are distributed, the system automatically increases your contribution rate by just 1%.
So you go from 3% to 4%, then 4% to 5%.
Exactly. And the magic is it happens without you ever having to make a conscious decision to save more.
And since it's timed with a raise, you don't even feel it.
Precisely. Because it's timed with your annual raise or cost of living adjustment, your actual take-home pay rarely goes down. You never feel the sting of losing income. You just don't see the full bump of the raise.
It harnesses human inertia for wealth creation instead of wealth destruction.
It saves younger workers from their own hesitation and gradually walks them up to that 15% target over a decade.
And the result of that inertia, that slow, painless, automated escalation, is a rapidly growing club of millionaires.
It is a big club.
Fidelity's data reports roughly 645,000 401k millionaires just within their own platform. Empower, another massive record keeper, looks at a broader set of retirement data and shows that the average retirement millionaire actually sits at a net worth of roughly $2.5 million.
Those are serious numbers.
They really are. But here's where it gets really interesting, and this is honestly my favorite detail from all the sources provided: who these people actually are.
Yes, they completely defy the cultural image of what wealth looks like in America.
Completely. When you say the word millionaire, people instantly picture celebrity investors, tech founders in Silicon Valley, or Wall Street hedge fund managers in bespoke suits.
Right, the 1%.
But the demographic data of 401k millionaires reveals something entirely different. According to the research, the top professions for everyday millionaires are engineers, public school teachers, accountants, nurses, middle managers, and factory workers.
It is a stunning list of professions.
It really is.
And it perfectly highlights the fundamental difference between the two wealth creation machines we introduced at the very beginning of this deep dive.
Oh, bring it back to Bitcoin.
Let's look at Bitcoin versus the 401k one more time, but now through the lens of human psychology and the demands they place on the investor.
Let's do it. Because to get rich on Bitcoin, the psychological burden placed on you was immense.
Unbelievable burden.
You had to possess extraordinary, almost prophetic foresight. You had to look at a highly speculative, deeply weird digital asset 10 or 15 years ago and decide to buy it when everyone thought it was a scam.
Right. And then you had to hold it.
Exactly. Then you had to ignore massive, gut-wrenching volatility. You had to survive crashes that routinely wiped out 80% of your portfolio's value in a matter of weeks. You had to watch your net worth plunge by 6 figures and somehow hold on for a decade without panicking and hitting the sell button.
Which almost no one can do.
The sources point out that studies consistently show average investor returns are almost always drastically lower than the actual asset's returns. Why? Because human beings inevitably buy into the hype at the absolute top when it's on the new, and they sell in absolute terror at the bottom.
The asset itself, Bitcoin, performed brilliantly over a 10-year horizon. But the mental fortitude required for a human being to actually capture and hold those returns was incredibly rare.
It required nerves of steel.
Nerves of steel and an almost irrational conviction. Now, contrast that immense psychological burden with the profile of the average 401k millionaire.
The teachers and the nurses.
Right. The nurse with $2.5 million did not make perfect macroeconomic predictions. They didn't study yield curves or time the market tops and bottoms.
They just worked their shifts.
They just worked their shifts. They stayed invested for an average of 26 years. They kept their contribution rates high through automatic escalation. They always captured the free employer match.
And most importantly, they simply resisted the urge to interrupt the machine.
Exactly. They didn't log in and pull the money out when the market crashed in 2008, and they didn't pull it out to buy a boat in 2015 when the market was booming. They just let the payroll system do its job.
So what does this all mean when we connect it to the bigger picture, when we look at the legacy of these two systems?
The ultimate takeaway is a profound contrast in what these two financial systems proved about wealth. Bitcoin changed the financial world by proving that decentralized digital assets could hold tremendous value and create explosive, unprecedented wealth for early adopters.
It was a revolution in what constitutes money.
But the 401k changed the actual fabric of American society by proving that ordinary, mundane payroll deductions could create sustainable, generational wealth for the working class.
Wow.
One system rewarded extraordinary brilliance, massive risk tolerance, and impeccable timing. The other system rewarded ordinary consistency, patience, and automation.
It really makes you reflect on the stories we choose to tell about wealth as a culture. I
Yeah.
mean, history and media will always naturally gravitate towards celebrating the spectacular fortunes.
Of course.
We will always write books and produce movies about the crypto billionaires, the visionary startup founders who changed the world in their garages, the genius traders who shorted the market at the perfect second.
Those stories have narrative tension. They have heroes and villains.
They're exciting.
Mhm.
Nobody makes a Hollywood thriller about a middle manager slowly dollar cost averaging into a Vanguard target date fund over 30 years.
No, that would be a terrible movie.
Right. But statistically, the undeniable reality is that the largest, most successful wealth-building engine in this country operates completely silently, without any fanfare.
Just humming along.
It happens every other Friday, every single payday in the background of hospitals, public schools, manufacturing plants, and suburban office parks all across the country.
Millions of everyday Americans quietly transitioned into millionaires.
Not by hunting for the next big disruptive technology, but by simply getting out of their own way and letting 40 years of compound mathematics do what human emotion is fundamentally incapable of doing.
It is the profound transformation of small, automatic, highly unglamorous investments into extraordinary financial security. It's an amazing arc.
It really is.
We started this conversation looking back at the 1970s, looking at a broken, mathematically doomed pension system and a minor accidental tax loophole meant for executives. And we arrived at a highly engineered behavioral system that built a $2.5 million net worth for a public school teacher.
It's an incredible journey when you lay it all out like that. It completely flips how you view that boring paperwork in your HR folder.
It does.
Yeah.
And I think it leaves you with a really fascinating, broader question to consider.
Okay, let's hear it.
We've spent this entire deep dive looking at how the greatest wealth engine in modern history only works because it ruthlessly removes human decision-making. It succeeds because it bypasses our willpower and simply automates the right choice.
Right.
It forces you to ask, what other critical areas of your life, your physical health, the trajectory of your career, your personal relationships, while unintentionally sabotaging simply because you haven't found a way to automate the right behavior?
Wow. That is a perfect, slightly uncomfortable, but deeply necessary place to leave it. Thank you for joining us on this deep dive into the hidden mechanics of the 401k. We will see you next time.